The union budget for financial year 17-18 got announced today. If you look at the key summary of events from a market perspective, it is that the government announced a fiscal deficit target of 3.2% of GDP for next year. Now, this is a bit higher than the 3% which was indicated in the fiscal roadmap last year. Remember that every year the government presents a 3-year roadmap for fiscal deficit, and last year they said 3.5%, 3%, 3%. That is to say, the fiscal deficit target for this year should have been 3. They've just taken a slight tick up to 3.2%. This is not materially higher. And in fact, if you look at some of the key metrics, including the borrowing number, 5.8 lakh crores, is pretty much bang on in line with market expectation. And that's the reason why the markets have been fairly quiet in the aftermath of the budget. Usually in budget years, especially if you have a big surprise, market does tend to move around a lot. Markets are very quiet. There are 2 or 3 things that we take away from this budget. Firstly, there's a lot of continuity. The government has not made significant changes to taxation or other parameters. One of the key reasons for this is the coming year sees the introduction of the goods and services tax. This is a very big tax reform. And that's the reason why the government has said that, why change taxes for the next 2 to 3 months? Anyway, in July, you're going to have a whole new set of taxes coming in. So the market will really look for GST to provide the next kicker in terms of direction of taxes and direction for growth anyway, or the direction for the budget. The government estimates the 3.2% fiscal deficit next year compared to 3.5% this year, like I said. And what we have seen over the last 3 to 4 years is, it doesn't matter whether the tax estimates are a little bit higher or lower than normal. By the end of the year, they have been strict about achieving the number indicated. And as long as they achieve the 3.2% fiscal deficit projected, the markets are likely to be reasonably happy going forward. From a macroeconomic standpoint, it's very important that the government brings its fiscal deficit lower to 3% as soon as possible. The FRBM targets has been to bring the fiscal deficit number to 3 and is already delayed by now 2 years. That is to say, we were supposed to have hit 3% fiscal deficit target in fiscal 17, the current financial year. We have postponed it by 2 years, which is not too much from a macro perspective, but still, the market expectation is that we should get to this as soon as possible. Much more importantly, the government now says that we also need to look at the total debt to GDP ratio, and now has set itself a target to bring the debt to GDP ratio down to 60% in the next few years. That implies a reduction of about 4 to 5 percentage points from where it is today. Much of that consolidation will in fact happen in the next 2 years itself. And this is good news. So you're bringing the deficit lower and you're bringing the overall debt overhang down over the next couple of years. And that broadly is in line with the way prudent macroeconomics dictates. Bringing the deficit down and bringing the debt to GDP ratio down is what prudent macroeconomics dictates, and that's really what the government intends to do. So broadly from a macro perspective, this is a good budget. Setting a fairly achievable and reasonable target of 3.2% fiscal deficit also opens up the room for RBI to cut rates in the next coming policy decisions. We have been expecting the RBI to cut rates by 25 to 50 basis points, given where inflation is and where we expected the budget deficit to be. And today's budget does not really change the outlook for RBI. So we continue to expect RBI to deliver those rate cuts in the next few months. One interesting development that we saw in the budget this time is the government has made a provision for buyback of securities to the extent of 75,000 crores. Each year the government has about 1.5 to 2 lakh crores of maturities of old bonds. What the government realizes is that given the cash on hand, perhaps they should buy back some of these near-term maturing debt so that the future years is easier to manage from a fiscal perspective. But this makes very interesting opportunity for us as investors. Today you have a situation that the banking system liquidity is abundant post demonetization, and this means short-term rates are being held lower. In addition, now you have 75,000 crores of potential buying by the government itself in short-term securities. So we believe that the opportunity is to invest in short-term assets as compared to long bonds. If you look at the longer-dated securities, the 10-year GSEC is just under 6.5%. compared to the overnight repo rate of 6 quarter, which means the market has substantially priced in a lot of positives from the low inflation that we see today to some RBI rate cut expectations. We believe that the action is really at the short end, where the opportunity continues to remain for those rate cuts and the liquidity to play into the markets.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.